A very good afternoon to you, Marcel. Now, first thing, let's start off with the IMF. We had the IMF coming out yesterday and saying that they're seeing Kenya's economy growing by 5% in 2012. Is this in line with your expectations?
Well, good afternoon. The 5% to us is probably closer to the average between this year and next year. From where we stand, we'll probably be looking at something around 4% and something north of 5% in 2013. As a matter of fact, this is, if you're looking at where we stand, it fits perfectly well with the perhaps more benign and more macro stability story that we're putting out, or we see in Kenya at the moment.
And it also lies with which sectors are likely to drive that growth going forward. Looking at the sectors currently in Kenya, which sectors do you see driving that 5%?
Well, we have to fall back into sort of the institutional agricultural sector. We can also see manufacturing coming through, and certainly financial services. When you sort of look at the broader picture, with inflation coming down, rates coming down, the shilling sort of testing 85, but broadly stable, and now GDP growth looking a lot better than it probably did at the beginning of the year.
We also had the IMF here coming out and saying that their growth forecast really is dependent on the election next year. So they're pretty cautious on that 5%. How much of an impact do you see the elections having on growth going forward?
Well, on growth itself, it isn't. You would expect perhaps some impact in the first or the second quarter, but the trend, if you want, from a growth perspective, is still fairly upbeat. And yes, we could have some volatility in a market, also certainly within the NSE 20, going into the elections. But broadly speaking, this should be relatively benign, certainly judging from a historic performance.
And looking at the NSE 20, really failing to reach that 4,000 points mark. We've had investors really moving out of the fixed income market into the equities market, with the banking sector receiving a lot of interest. Without looking at the banking sector, what are the sectors are you seeing a bit of opportunity right now?
Well, broadly speaking, what we're looking at as a macro environment, I should say, should actually speak for a sort of growth in corporate earnings in the next 2 to 3 years. And as a matter of fact, that actually pushes more into the allocation into equities. And in terms of sectors, you could be looking at banks, obviously, but you could also be looking at consumers, or you could be looking at manufacturing or construction, so to speak. This for many reasons. With the banks, however, what you have to be fairly careful about is the selections of it. First, in terms of capital, strong capital is welcome. Access to funding is welcome, especially in an environment where we see loan growth potentially coming back in, and that pushing certainly on the consumption side as well, and that feeding into perhaps better business confidence. When it comes to certainly if we're looking at consumers, lower inflation and perhaps growth in GDP could actually help in terms of revenues going forward.
And looking at the inflation picture, with some saying that inflation is due to trend lower in September, coming in at levels of about 5.4%. Is that a level that you perhaps are seeing for inflation? Perhaps talk us through your outlook for inflation for the rest of the year. We seem to have lost...
On the question of what to do now in terms of asset allocation, what is very important for us at this stage is that the fixed income environment is relatively benign, or looks relatively benign, at least for the time being. And therefore, that buys investors perhaps more time in terms of looking at where to put their money. Our house view is that time seems ripe for equities, and they do have time to probably look into the different profiles. Mm-hmm. If you're looking at banks, defensiveness but not cheap could come from Barclays. If you're looking at if you're looking at perhaps cost efficiencies and growth in the region, your KCB could be a very good place to be in.
Well, thanks so much for joining us, Marcel.
If you're looking at consumers, as I said, it is very important to look at perhaps how disposable income is going to grow going forward, and retailers or discretionary consumers could be a good place to be. We have looked at brewers perhaps as also an important part, especially with inflation being perhaps more amenable to their cost base.
Well, thank you so much for joining us, Marcel. That was Marcel Mballa-Ekobena, Head of Equity Research at CFC Stanbic Bank.